Have you ever driven past a massive factory or seen a fleet of delivery trucks and wondered about them? Well, on a company's financial statements, every single one of those assets tells a story. And today, we're going to follow that story from the day an asset is born to the day it's retired. Okay, so let's start with a really simple idea. Any company that makes or moves things relies on, well, stuff. A car company? It needs an assembly line. Your favorite pizza place? It needs ovens. A shipping company needs planes and trucks. This is the physical backbone that makes the entire business go. But here's the real question, the one that's worth billions of dollars. How do you put a value on all that stuff? Not just today, but over its entire life. See, it's not just a number on a page. It's a whole narrative of investment, of use, and eventually of retirement. And if you can understand this life cycle, you can understand a company's health in a much deeper way. So let's dive in. All right, first things first, we need to know what we're talking about. In the world of accounting, this stuff has a name: property, plant, and equipment, or as everyone calls it, PP&E. These are the tangible workhorses of a company. So, PP&E are the heavy lifters. They're the long-term, physical things a company uses to actually make money. Now, the key here is that these are not items for sale. Think about a car dealership. All the cars on the lot, that's inventory. But the building itself, the showroom they operate out of, that's PP&E. To really get a handle on this, let's follow the life of just one asset. Let's imagine a restaurant chain is expanding, and they just bought a shiny new top-of-the-line pizza oven. Its story doesn't just start with the price tag. It starts with its true total cost. In accounting jargon, this is called the capitalized cost. And a great way to think about this is to imagine the accountants have a big cost bucket for this new oven. They don't just drop the sticker price in there. Nope. They fill that bucket with every single cost it took to get that oven installed and ready to start baking pizzas. So what goes in the buckets? Well, the price of the oven, of course, but also the shipping fees to get it to the restaurant, the cost to have specialists come in and install it, even the price of the first few pizzas they make just to test it and make sure it's calibrated correctly. Basically, any cost that is necessary to get that oven ready for its intended use gets thrown into the bucket. So what about costs down the road? What happens if a few years from now we add a new conveyor belt system to the oven? Well, that cost only gets added to the bucket, capitalized, if that upgrade makes the oven significantly bigger, better, or last longer. A simple repair to fix a broken handle? Nah, that's just a regular expense for the year. Okay, our pizza oven is in, it's working perfectly, and it's churning out pizzas and making the company money. This kicks off the second chapter of its life, a long, productive period of service, and the way we account for this period of use is with a concept called depreciation. Now, this is one of the most misunderstood ideas in all of accounting. Depreciation is not about the oven losing market value, like a car driving off a lot. It's an accounting tool. It's about taking that big cost bucket we filled up at the beginning and systematically spreading that cost out over the years the oven is actually helping us generate revenue. It's all about matching the expense to the income it creates. And what's really interesting here is that companies get a choice. They can use the simple straight-line method where they just expense an equal slice of the cost each year. Or they might use an accelerated method where they take a bigger expense hit in the early years when the asset is newest and most productive. The whole point is to pick the method that best reflects how the company is actually using up the economic benefit of that asset. So years go by. Our pizza oven has been a real workhorse, but then a crisis. What if some inventor creates a revolutionary flash baking oven that cooks a perfect pizza in 30 seconds? Suddenly, our old oven looks slow and obsolete. In the life of an asset, this is a crisis point, and it's called impairment. Now, the oven still works, sure, but its ability to make money for the company has taken a serious hit. So how do accountants figure out if the value on their books is now totally wrong? Well, they don't just guess. There's a very specific two-step test they have to run. And it's a really logical process. Step one is just asking, is there even a problem here? That's the recoverability test. And only if the answer to that is yes, there's a problem, do you move on to step two, which is measuring just how big that problem actually is. So this right here, this is the trigger. It's the pass/fail moment. The company looks at the old oven and projects all the money they expect to make from it for the rest of its life. If that total amount of cash is less than the oven's current value on the balance sheet, its book value, then bam, the test is failed, the asset is officially impaired. So once it's failed the test, we have to measure the damage. And the impairment loss is actually pretty straightforward. It's the difference between what the books say the oven is worth the book value, and what it's actually worth on the open market today, its fair market value. The company has to take that difference and report it as a loss. And here is a super important rule to remember for any asset the company plans to keep using. Once you record that impairment loss, it is permanent. You can never reverse it. This is because of an accounting idea of being conservative. You don't want to overstate how much your assets are worth. So even if old school pizza makes a huge comeback and the oven becomes valuable again, too bad, you can't write the value back up. That loss is locked in forever. But wait, what if the company makes a totally different choice? Instead of trying to make do with their old, slow oven, management says, you know what, let's just sell this thing and get the new flash baker. That single decision to sell the asset changes the entire story. The second a company makes a formal plan to sell an asset, that asset gets reclassified. It goes from being held for use to held for sale. And this is way more than just a name change. It triggers a completely different set of rules for the asset's final chapter with the company. And you can see just how different it is right here. First off, you stop depreciating it immediately. Second, the way you value it changes. And third, and this is the big one, remember that rule about an impairment loss being permanent? Well, for an asset that's held for sale, that rule gets thrown out the window. If the market for old pizza ovens suddenly gets hot, the company can actually write the value of the asset back up. So there you have it, from the initial cost bucket through a long life of service to a potential crisis and its final sale. That's the complete life story of a corporate asset. So the next time you read that some huge company took a multi-billion-dollar write-down on its assets, you'll know what's really going on. It's not just some boring accounting move. It's the company admitting that a big bet they made in the past didn't work out, and it's a powerful signal about how they're being forced to change for the future.